March deliveries out of the Comex, silver deliveries, are
Wow.
the second highest in Comex history. And so what it means is that not only is the silver flowing to New York from London, but participants are taking delivery. They're requesting and getting their silver out of the Comex. The industrial users are taking delivery because they need it and don't want to have to pay tariffs, or didn't want to have to pay potential tariffs on it. And then the financial participants are saying, we want to have our hands on the physical silver, ahead of any potential run up, I think, in the price.
In an era marked by economic volatility and geopolitical tensions, precious metals like gold and silver have emerged as beacons of stability. Gold has recently soared to unprecedented heights, reaching a record $3,245 per ounce on April 11, 2025, driven by escalating global trade tensions and investor demand for safe haven assets. Silver, closely tied to industrial applications, has also experienced significant gains, with prices hovering around $32 per ounce. Peter Krauth, a renowned precious metals analyst, delves into the underlying factors influencing silver's performance. He highlights the dual nature of silver as both a monetary asset and an industrial commodity, noting that approximately 60% of silver demand now stems from industrial applications. This industrial demand, coupled with concerns over economic slowdowns, has led to fluctuations in silver prices. Krauth also discusses the structural deficits in the silver market, pointing out that for the past 5 years, demand has outpaced supply by about 200 million ounces annually. Despite this, silver prices haven't skyrocketed, partly because large consumers have tapped into secondary inventories in London, New York, and Shanghai to meet their needs without exerting upward pressure on prices. However, recent fears of tariffs prompted significant movements of silver and gold from London to New York as institutions aimed to preempt potential trade barriers. Interestingly, while gold and silver were eventually exempted from these tariffs, the initial uncertainty contributed to price volatility. As we navigate these complex dynamics, Krauth's insights offer a comprehensive understanding of the forces at play in the silver market. His analysis sheds light on why silver remains a critical asset for investors seeking both security and growth potential in uncertain times. As we present clips from Peter Krauth's recent interview with Capital Cosm, please take a little time to like this video, subscribe to the channel, and turn on the notifications bell for more videos like this. We appreciate the support and hope you enjoy the video.
I mean, I certainly agree with you on the precious metals. Gold and silver have held up exceptionally well. Gold clearly even better than silver has. And I guess, I can give some thoughts in terms of why I think these metals have gone the direction that they have. First of all, that they've held up well speaks to their safe haven recognition. That's always been the case. Gold in particular, gold is mostly a form of savings and inflation protection, chaos hedge, all these things. Silver is that too. I'm going to say to probably a little bit lesser of an extent, because there is so much of silver that's used industrially. 10 years ago, about half of silver went into industrial applications. That's actually grown to somewhere around 60% lately. And I think that, silver peaked about 3 or 4 weeks ago around 34, almost, I think $35 if you look at the futures price. I had been calling for silver to go to 35 in the first half of this year, and we certainly got there, but it's backed off now. We're somewhere just below 32 right now, and silver actually started to back off a little bit before gold did. And this, as I say, is about 3 or 4 weeks ago. So I think that the market saw that we had increasing risks of a recession, some kind of an economic slowdown, and with more silver going to industry than gold, the concern, I think, was that you'd have some lesser demand for silver than probably had been priced in previously. There's a lot of other factors that have been going into both metals rising pretty dramatically in the last few months. And the tariffs issue is certainly one of the biggest ones, and it is one for different reasons and from in different ways. I think what we saw too was that there was absolutely outsized quantities of silver and gold that were flowing mostly from London to New York on the fear that you'd have tariffs slapped onto these metals. And anyone who had to deliver serious quantities of either metal to contract holders basically wanted to get ahead of potential tariffs. So imagine, some large institution that has a big contract to deliver on could be, hundreds of thousands or more of ounces of these metals. And to be faced with a, 20-25% tariff on that amount, that could probably sink a lot of institutions overnight. So I think that they wanted to get the metal into the US, not have to worry about having to deliver that metal and pay tariffs on it. Now, interestingly, so that built a premium for me, at least, into the prices. Interestingly, those metals were exempt. There were several others, some base metals and some other things were exempt from the tariffs, but clearly gold and silver were exempt. So for silver, at least, that I think also contributes to the price having come back, that's sold off. Interestingly, we haven't seen that happen, or at least not for very long. Gold backed off for a very short time, a day or two after the Liberation Day announcements, and then has bounced back up and set even new all-time highs. So this goes back to what I was saying a bit earlier about the amount of silver that's been flowing out of London. We probably talked about this in a previous interview about a year ago. I was looking at what might be potentially capping the silver price, given that we're in multiple years of silver deficit. And actually, some of my next charts deal with that look at those numbers more specifically. But we've been in about 4 or 5 years. If you include this year, it'll be 5 years of silver deficit. The silver market's about 1 billion ounces of supply a year, and demand is about 1.2 billion ounces a year. So about 20% or 200 million ounces a year deficit. And you'd have to ask yourself, if we're in an ongoing structural deficit, why has the silver price sort of not pushed, above 35 and continued higher and almost exploded higher? And I think this is part of the answer. So any big users and consumers of silver have not had to pressure silver miners to produce more silver. They've been able to go to these secondary inventories that sit on the LBMA in London Futures Exchange, at the Comex in New York, and in Shanghai on the Shanghai Futures Exchange, and draw down. Basically, go to these secondary inventories, buy what they need by holding long contracts, waiting for them to mature, and then taking delivery. So they've been able to get their silver this way, and buy it at prevailing prices. So we saw this start to happen in sort of early to mid 2021, is that these inventories started to draw down, and they've come down, depending on which exchange, they've come down anywhere from about 40 to 70%. Interestingly, if you look at the last few months in the LBMA, what has happened there, because that has really dropped off again dramatically, to the point where it's almost becoming a critical level in terms of the silver inventories that are available for delivery.
Peter Krauth's observations raise an important point. Silver isn't just riding on its reputation as a safe haven asset. It's also navigating a web of global industrial trends, strategic stockpiling, and monetary policy shifts that are shaping its market in ways we haven't seen in decades. For one, the industrial case for silver continues to grow stronger. With the expansion of green energy technologies, especially solar panels, electric vehicles, and battery storage systems, demand for silver is being driven as much by technological progress as it is by financial uncertainty. According to the Silver Institute, industrial demand is expected to reach new highs in 2025, particularly as countries push for cleaner energy infrastructure and digitization across sectors. At the same time, the financial world is shifting. Central banks have become net buyers of gold again, with China, Russia, and several Middle Eastern nations quietly accumulating reserves. This renewed interest in hard assets is mirrored by institutional investors, who are increasingly viewing silver as poor man's gold, a high beta hedge against inflation and currency debasement. Meanwhile, the cracks in the global financial system are becoming more visible. Sovereign debt levels are at historic highs, and inflation remains persistent despite rate hikes, and geopolitical tensions, from trade wars to currency realignments, are adding layers of uncertainty. These pressures are prompting investors to reconsider physical assets like silver as part of a long-term defensive strategy. Another key development is the drawdown in above-ground silver inventories, particularly those stored in London and Comex vaults. With stockpiles down as much as 70% in some locations over the past few years, questions are emerging about the long-term sustainability of supply. This silent depletion of inventory has been a pressure release valve for silver prices, but one that can't be relied upon forever. All of these trends point to a fundamental repricing of silver not just as a commodity, but as a strategic asset in a rapidly evolving global economy. The current pullback may simply be the market catching its breath before the next leg up, especially if recession signals deepen or if industrial demand continues to surprise to the upside. Let's get back to the video.
Okay, so we got the Comex Depository Warehouse Silver. Walks through this one.
Yeah, so this is almost like it's the mirror image of what's been happening in London, right? So, and especially for the last few months, we have outsized deliveries of silver coming out of London and outsized deliveries going into the Comex in New York. This explains where a lot of the silver from London has ended up. So, you know, some people will say, is there a shortage in silver? So a couple of, thoughts around that. Technically, silver flowing from London to New York doesn't cause a shortage. It just changes where the silver is held. However, if you look at the next chart, then you'll see what is happening when it comes to the silver ending up in New York. So we see that very last bar all the way over on the right. March deliveries out of the Comex, silver deliveries, are the second highest in Comex history. And so what it means is that not only is the silver flowing to New York from London, but participants are taking delivery. They're requesting and getting their silver out of the Comex. This is very telling. I think that what happens is you've probably got, in both, my view is that you probably have industrial users and some sort of institutional financial participants saying, we are not going to leave this on the exchange even if we have our futures contract with a claim for it. The industrial users are taking delivery because they need it and don't want to have to pay tariffs, or didn't want to have to pay potential tariffs on it. And then the financial participants are saying, we want to have our hands on the physical silver, ahead of any potential run up, I think, in the price. And so this, again, I think is very telling, that to see these huge amounts of deliveries. I mean, I've heard anecdotally that there's a lot of, in addition to this, that a lot of the silver that has flowed into New York has gone into the Comex. A lot of it has also just gone straight to private vaults in the New York area, just sort of sitting there, probably owned by some of the investment banks and so on, the bullion banks, and just basically sitting on a position and being ready in case that you get this potential large move up in the silver price. So if you could, we can talk a little bit about what I mentioned earlier in some of the fundamentals in the next chart. So I was talking about silver deficits. So these 5 red bars all the way on the right are including this year. So this last year is an estimate, and that is 149 million ounces. I think that's what the Silver Institute is expecting that we're going to see this year in terms of a shortage. I think it's actually going to be closer to what we had last year, around 180 million ounces. But the point is that if you take the average of these last 5 years, pretty significant structural deficits, you're somewhere around 200 million ounces per year. And if you add these 5 years together, that's an entire year's supply of silver when you combine mining and recycling. So about 1 billion ounces. So we're in deficit of 1 billion ounces across the last 5 years. That is really quite something. And the fact that the silver price has not exploded in this kind of environment tells me that yes, those consumers of the silver have, again, that to me explains what we saw in that earlier chart from London, and the charts for the Comex and for Shanghai are similar in terms of drawdown of silver the last 4 years. So I think that is clearly tells us that's what has met these deficits, but that can only go on for so long. These inventories have gotten pretty seriously low. I think that we could have maybe 12 months, maybe 18 left in that. The argument from there tends to be, well, there's a lot of private silver that's held, private hoards of silver, especially in the East in Asia, for example. And so, my counter to that is, yes, there are probably several billion ounces at least of silver that's held privately. And that, the argument is that this silver will come to market if if the deficits persist. I think that they will come to market, but at much higher prices. They will come to market not at $35 or at $40, but at $45 or $50 or $60 or $70. That's when those people will be willing to sell their silver back into the market and help to meet these deficits. And at that point, that's that, so to speak, self-fulfilling prophecy where you've gotten that's helped to push these silver prices higher.
As Peter Krauth points out, the narrative unfolding in the silver market is more than just numbers on a chart. It's a structural story built on scarcity, urgency, and strategic repositioning. The dramatic surge in silver deliveries from Comex, the quiet exodus of metal from London, and the movement into private vaults all point to one thing. Those who understand the fundamentals are no longer content with paper claims. They're securing physical silver, now, before the rest of the market catches on. And with 5 consecutive years of deficits already depleting global inventories, the clock is ticking. Whether the next chapter brings $40 silver or $70, the message is clear. The days of easy access to undervalued silver may be numbered. What comes next could redefine how the world sees this metal, not just as a commodity, but as a cornerstone of both financial resilience and industrial evolution. If you've been watching the silver market from the sidelines, now might be the time to take a closer look. The signs are all around us: structural deficits, rising industrial demand, and a growing appetite for physical metal among those who see what's coming. What are your thoughts? Are we on the edge of a silver breakout, or just beginning a longer, quieter accumulation phase? Drop your insights in the comments. We'd love to hear your take. If you found this analysis valuable, don't forget to like the video, subscribe for more market intelligence, and hit the notification bell so you don't miss our next deep dive. The future of silver is still being written. Make sure you're part of the conversation. Thanks for watching, and see you in the next one.